Usually when we talk about a company's financial quarter, there's this underlying expectation of gravity, like physics, you
Well,
know?
the law of large numbers kicks in. It's just a fundamental principle of business physics.
Exactly. A business gets to a certain massive size, and the growth just naturally has to slow down, and the math demands it.
Oh yeah, you can't just keep doubling in size forever when you're already a behemoth.
Because finding new customers becomes exponentially harder and more expensive, which makes the current landscape of the enterprise artificial intelligence space so jarring.
Yeah, gravity seems completely broken right now.
It really does. We are looking at a financial and operational landscape that is redefining the parameters of what, hypergrowth looks like at a massive scale.
It forces a total reevaluation of the traditional SaaS playbook, honestly. The metrics we use to judge software health are being stretched to their absolute limits.
Totally. So it is Monday, May 4, 2026. Welcome to the deep dive. Today, we are staring down a massive stack of notes, an earnings transcript, a highly detailed business update, and a shareholder letter.
All centered on Palantir's Q1 2026 earnings.
Right. Palantir just posted what looks to be its strongest quarter ever as a public company. And the stakes for you, the listener, are incredibly high here.
They really are.
Because with a valuation that is absolutely soaring, we have to figure out if this is just, the crest of an AI hype cycle, or if they have genuinely cracked the code on making enterprise AI functional and, more importantly, profitable.
Yeah, that's the big question.
Okay, let's unpack this. We need to understand the underlying mechanisms, the why and the how behind these massive gravity-defying numbers.
Our mission for this deep dive is to synthesize the reality beneath the hype. We really have to establish the baseline of the raw financials first to see what actually just happened.
Right, get the ground truth.
Exactly. Then, we need to evaluate the underlying business quality to understand how their technology actually functions in the real world to drive this kind of scale.
Which is complex.
Very.
Well,
And finally, we have to stress test the strategic risks and do a valuation reality check. Because achieving hypergrowth at a multi-billion-dollar run rate creates a very unique, highly precarious set of expectations.
it's priced for perfection, right? But let's start with the raw headline numbers because they are almost difficult to process.
They are staggering.
For Q1 2026, Palantir's revenue hit approximately $1.63 billion. That is up 85% year over year.
Wow.
But the figure that really stops you in your tracks is that it is up 16% sequentially from just the previous quarter.
Yeah, that's a lot.
And they beat consensus estimates across the board, a 5.9% revenue beat, and a 17% beat on earnings per share, coming in at a GAAP EPS of 34 cents.
That sequential growth of 16% is the detail that truly matters for institutional investors.
Why is that one so important?
Well, for a company of this size, quarter-over-quarter growth usually hovers in the low single digits. Hitting 16% sequentially represents the strongest Q1 sequential growth in Palantir's public history.
Oh, wow.
It indicates that their momentum is accelerating in real time.
Yeah.
They aren't just, coasting on the revenue realization of older multi-year contracts.
Which is wild because growing a software startup at 85% year over year is expected when your revenue is like $10 million.
Right, the base is small.
But doing it at a $1.6 billion quarterly run rate.
Hmm.
Normally, scaling at that speed requires thousands of new sales reps, millions in marketing, and massive implementation teams.
Huge overhead.
Yeah. It is like adding heavy steel boxcars to a miles-long freight train while trying to accelerate it like a sports car. The sheer weight of customer acquisition costs usually slows down your momentum or just rips the engine apart entirely.
That's a great way to put it.
Which leads me to the core mechanical question here. I see in the notes they hit a Rule of 40 score of roughly 145. How are they physically achieving this kind of massive revenue growth without burning through mountains of cash to acquire and onboard those customers?
It really challenges the conventional understanding of operating leverage. To appreciate a Rule of 40 score of 145, we should look at how that metric is constructed.
Break that down for us.
It is simply a company's revenue growth rate added to its profit margin. So in the software industry, if your combined score is 40, you are considered a healthy, sustainable business.
Okay, so 40 is good.
Right. If you hit 70, you are in the elite tier of capital efficiency.
And they hit 145.
Exactly. Hitting 145 completely shatters the scale. They achieved that because the 85% revenue growth was paired with massive scaling and profitability.
Let's look at those profit margins because the sources show some staggering figures here. Their GAAP net margin, which is the strictest accounting standard for profit, was above 50%.
Which is almost unheard of.
Right. Their adjusted operating margin, which looks at the profitability of their core business operations, hit 60%. And their adjusted free cash flow margin was around 57%.
What's fascinating here is that this proves they possess unprecedented operating leverage. They aren't buying this revenue with heavy marketing spend or, aggressive discounting.
So the software basically sells itself.
In a way, yes. The underlying cost to deliver and maintain their software isn't rising anywhere near as fast as the revenue it generates. Every new dollar of revenue is dropping almost straight to the bottom line.
Okay, but if they aren't spending mountains of cash to capture these margins, who is buying the software at this scale? Because the sources reveal this efficiency is heavily localized.
Very localized.
The freight train is being driven almost entirely by an unprecedented surge in the United States, right?
Yes. The U.S. market has become the undisputed engine of Palantir. U.S. revenue made up 79% of their total revenue.
That's huge.
It is. That translates to $1.28 billion just from domestic operations, and that's growing 104% year over year.
Over 100%. Just wild.
And the standout metric within that is U.S. commercial revenue, which grew an astonishing 133% year over year.
133% growth in U.S. businesses buying this software. And these aren't just new logos signing up either. The net dollar retention metric hit 150%.
Which is a crucial number.
It tells us that if you look at the customers Palantir had exactly 1 year ago, those same organizations are now spending 50% more today. They are rapidly expanding their use of the platform across their various departments.
The CEO, Alex Karp, characterizes this demand as once in a lifetime. He explicitly positions Palantir as an N of 1 in production AI.
Meaning they are in a category of one, completely alone in their capability.
Exactly. He also draws a hard line against competitors by warning against what he calls AI slop.
Okay, here's where it gets really interesting, and we need to push back a bit on the corporate buzzword.
Fair enough.
Because every single enterprise software earnings call we read right now claims they have the ultimate transformative AI platform. Everyone has an AI co-pilot,
Yeah. Oh, absolutely. Everyone is integrating generative models.
So what mechanically separates Palantir from the rest of the pack? Why are companies expanding their spend by 50% with them, rather than just using cheaper off-the-shelf AI tools?
The distinction lies in the underlying architecture of how the AI is deployed. Most of what the market offers right now, the AI slop Palantir refers to, are generic large language models bolted onto existing software interfaces.
Like a chat window.
Right. It is a chat window that can summarize a long email chain, generate a generic marketing report, or write basic code snippets. It is a productivity hack, but it doesn't understand the physical reality of the business.
So it's surface level.
Exactly. Palantir approaches this entirely differently. They provide what their CTO calls an agent operating system built on a strict, highly detailed ontology.
Okay, let's make ontology tangible for you listening. How does an ontology actually function in a massive legacy business environment?
Think of an ontology as a highly structured, multidimensional digital map of a company's entire physical and digital reality.
A digital map, got it.
In a massive enterprise, data is usually trapped in messy, disconnected silos. You have a human resources database built in 2004, a modern cloud-based financial ledger, and real-time sensor data coming off a factory floor.
And none of them talk to each other.
Right. A generic AI can't read all of those simultaneously.
Yeah.
Palantir's ontology ingests all of those disparate systems and connects them into one single logical framework where the relationships between the data points are strictly defined.
So generic AI tells you what a company policy says, but Palantir's AI navigating this ontology map can actually execute a complex, multi-step process securely.
Yes, exactly.
Imagine a major global automotive manufacturer facing a sudden parts shortage. A standard AI model might draft and alert email, right?
Right, hey, we're out of parts.
But Palantir's system, acting as an agent operating system, can autonomously suggest rerouting a shipment from an alternate supplier, check the HR database to ensure the factory workers on shift are certified to install the new part, and update the financial ledger to reflect the new cost, all in real time.
That is the exact mechanism. We can think of Palantir's platform like an air traffic control tower.
I like that analogy.
The tower doesn't actually fly the planes. The planes are the various AI models, whether they're open source or proprietary models from big tech giants. Palantir's software is the control tower that dictates exactly where, when, and how those models are allowed to land safely within the enterprise.
Okay, that makes sense.
They call this a no-slop zone because it is engineered for what they term load-bearing institutions.
Load-bearing meaning the Department of Defense, major financial clearinghouses, or global hospital networks. Places where the cost of a mistake isn't just a typo in a marketing email.
Exactly the opposite of a typo. In a hospital network or a military deployment, you cannot afford to have an AI hallucinate a supply chain order or misidentify a target.
Right, the stakes are life or death, or billions of dollars.
Strict access controls, data security, and exact attribution for every automated decision are non-negotiable. Palantir's system knows exactly who has the authority to approve a change, and it tracks the financial and operational impact instantaneously.
And once a massive industrial company integrates that level of central operational control, it becomes the nervous system of the business.
Very sticky.
It is incredibly sticky, which mechanically explains that 150% net dollar retention rate we talked about earlier.
Exactly.
But, having a product that essentially becomes the central nervous system of global enterprises creates an entirely different operational bottleneck.
The capacity issue.
Yes, the physical capacity to actually install and fulfill that surging demand. Looking through the business update, management explicitly admits to capacity constraints. They say plainly that the demand in the U.S. vastly exceeds what they can currently serve.
Admitting to supply constraints is a fascinating anomaly for a software company. Software is supposed to have infinite supply, you just duplicate the code.
Right, you just copy and paste.
But deploying an ontology-driven system that adapts the bespoke realities of a multinational corporation requires deep, elite technical expertise to set up. It's not plug and play.
The shareholder letter contains a statistic that attempts to frame this efficiency, though. The CEO notes they're doing what a normal company would do with 7,000 salespeople. With just 7.
It sounds impossible.
It does. Their revenue per employee globally is hovering around $1.5 million. Now, that sounds like a great talking point for a slide deck, but how is that actually possible? How do 7 people sell to the Fortune 500?
They utilize an immersive strategy they call boot camps. Instead of a traditional sales cycle involving months of PowerPoint presentations and steak dinners, they bring a prospective client's own data into a secure Palantir instance.
Oh, so they use real data immediately.
Within a matter of days, the client's executives are interacting with a live functional ontology of their own business. The product effectively sells itself through immediate, tangible demonstration, which bypasses the need for a massive traditional sales force.
Even with that boot camp efficiency, the overall capacity limit is glaring. And it brings up a critical friction point.
Yeah, the prioritization.
Right. If you are a major commercial client, say a massive European airline or a global bank, and you read that Palantir is constrained, and the CEO explicitly states they will prioritize U.S. national security workloads over commercial or international deals, doesn't that make you hesitate?
It certainly could.
The message seems to be, you might get left behind if the Pentagon calls. And just to be clear for everyone listening, when we talk about Palantir's pro-U.S. defense stance, we are simply reporting on the CEO's stated corporate strategy and geopolitical priorities from the earnings transcripts. We aren't endorsing any specific political, nationalistic, or geopolitical viewpoint here.
Right, just analyzing the business impact.
Exactly. But purely from a business perspective, isn't that prioritization a massive risk for their commercial ambitions?
If we connect this to the bigger picture, you have identified the exact bottleneck that represents their primary execution risk. The U.S. defense and intelligence sector provides an incredibly durable, high-margin moat.
A guaranteed customer, basically.
It is the bedrock of their recurring revenue. However, tying your capacity so tightly to the Department of Defense exposes the company to intense, unpredictable political and budget cycles.
Like government shutdowns.
Right. Continuing resolutions in Congress, where defense budgets are frozen or delayed for months, can suddenly stall major contract expansions.
And we are already seeing the physical limits of this U.S.-first focus reflected in the international numbers. While U.S. commercial grew at 133%, international commercial growth is lagging significantly at only 26% year over year.
That massive divide highlights the opportunity cost of their strategy. Differing regulatory environments around AI in places like the European Union create friction, but Palantir's unabashed alignment with U.S. national security also limits their appeal or priority in certain foreign markets.
They are leaving global commercial market share on the table simply because they are physically bottlenecked by how fast they can hire elite engineers to deploy these systems domestically.
Exactly.
They have built a cash printing machine in the U.S. commercial market, backed by a defense moat, but they are hitting the physical limits of their own human capital.
Which brings us to the financial reality check.
Evaluation.
Yes. If you are analyzing this from an investment or strategic standpoint, you have to wonder, even if Palantir is the undisputed leader in enterprise AI with the best product, how much is that future dominance actually worth today?
This is where we pivot from technological supremacy to pure financial physics. At the time of this report, with the stock trading around $146 a share, Palantir commands a forward price-to-earnings ratio of about 94 times.
Let's ground that metric for a second. A forward PE of 94 means investors are willing to pay $94 today for every $1 of profit the company is expected to generate over the next year.
It is an incredibly steep premium. We also look at the forward price earnings to growth, or PEG ratio. What does that measure?
A PEG ratio takes that high PE multiple and divides it by the expected earnings growth rate. A baseline ratio of 1 is often considered fair value for a growing company. Palantir's forward PEG ratio is above 2.1.
Oh, wow. Double the baseline.
Even comparing forward price to sales, their multiple is materially higher than other high-growth SaaS darlings. Snowflake, which is a massive consumption-based data warehousing platform, trades at roughly 10.7 times forward sales.
Okay, and MongoDB?
MongoDB, a leading document database company, sits at about 8.7 times. Palantir is commanding a vast premium over peers who are also fundamentally critical to modern enterprise data architecture.
So what does this all mean? The market isn't just pricing in growth, it is pricing in absolute perfection.
Flawless execution.
If a stock requires a 94x forward PE to justify its price, doesn't that inherently mean there is zero margin for error? If U.S. commercial growth drops from 133% down to 50%, which frankly would still be an incredible growth rate for almost any other company, wouldn't the valuation collapse simply because the hypergrowth narrative took a slight breather?
The thesis audit in our sources arrives at a hold to add stance specifically because of this extreme tension. There is incredibly high confidence in the underlying quality of the business and the technology.
But the stock price is a different story.
Right. There is only medium confidence in the near-term, risk-adjusted returns because the valuation is so demanding. You have to monitor the operational tripwires carefully.
What specific tripwires should we be looking out for in the upcoming quarters?
Two primary metrics will dictate the near-term valuation. First, if U.S. commercial growth drops below 100% year over year.
That would be a red flag for the market.
Second, if that unprecedented Rule of 40 score, which is currently at 145, falls below 100 for more than one consecutive quarter, the market is paying a premium for a sustained anomaly.
So if the anomaly starts looking normal,
Any sign that the anomaly is normalizing back into a standard software growth trajectory will likely cause that massive valuation multiple to compress sharply. That would drive the stock price down even if the core business remains healthy.
but, and this is important, the core business itself is insulated by one of the strongest balance sheets in the tech sector right now. Palantir is sitting on $2.29 billion in cash and cash equivalents, and they have zero debt.
Zero debt in a fluctuating interest rate environment is a formidable superpower.
It's a huge safety net.
It entirely insulates them from credit market shocks or refinancing risks. Furthermore, they generated $899 million in operating cash flow and $925 million in adjusted free cash flow just in the first quarter.
Because they are generating massive amounts of cash and have no debt to service, they can entirely self-fund their aggressive expansion, hire those elite engineers, and fund their AI research without ever needing to tap the capital markets or issue new debt.
The underlying company is a fortress. Even if the stock price takes a hit due to multiple compression, they are not at risk of bankruptcy or forced dilutive stock offerings just to keep the lights on.
So the business is safe even if the stock is volatile.
Exactly. The risk profile is almost entirely concentrated on the stock's valuation multiple, not the operational survival of the business itself.
Bringing this all into focus, Palantir has definitively proven that it provides the leading operational AI infrastructure for mission-critical, load-bearing workloads. Their ontology-driven approach is yielding unprecedented unit economics.
A rule of 145 is a benchmark we may not see again in enterprise software anytime soon.
It really is. The primary risk isn't whether their product functions. It is whether an astronomical valuation can hold up while they navigate the operational challenge of hiring elite talent fast enough to meet a demand that currently outstrips their capacity.
It is the ultimate test of execution. They have built a phenomenal business,
Yeah.
but the market has already fully recognized it and priced it for historic, flawless performance.
And before we wrap up, I want to leave you with a lingering thought to mull over, something that pushes the implications of this deep dive into entirely new territory.
Let's hear it.
If Palantir's highly structured, ontology-driven approach, this strict no-slop zone, is truly the only way to make AI functional, measurable, and safe in high-stakes environments, what does that imply about the billions of dollars currently being poured into generic, standalone AI models?
Oh, this raises an important question regarding the fundamental architecture of the future AI economy.
Are we heading toward a future where the base AI models themselves become cheap, highly commoditized utilities, like electricity or internet bandwidth, essential but ultimately low margin?
That's a very real possibility.
And if so, does that mean all the actual value, all the real power and profit will rest exclusively with the operational data gatekeepers like Palantir, the ones who actually hold the map and know how to plug that raw AI utility into the real world safely?
It could be a complete paradigm shift in where the true economic value of artificial intelligence actually lives.
It's a fascinating thing to think about. Thank you so much for joining us on this deep dive. We love unpacking these complex landscapes with you, and we will catch you on the next one.